Welcome to Connect, the podcast for California MBA, featuring one-on-one interviews with the movers and shakers in the mortgage industry. My name is Paul Gelati, CEO of the California MBA, and I am so thrilled that you could join us today. Before we get to today's guest, I'd like to thank our 2025 Presidential Council sponsors, those companies AmeriHome, Consolidated Analytics, Funding Shield, Guild Mortgage, Rocket Mortgage, Weiner Brodsky Kinder, and Western Alliance Bank. These organizations and companies provide such a tremendous level of financial support for our association, and we greatly appreciate their continued support. All right, let's dive in. On today's California MBA Connect podcast, we're jumping in with a theme of turning volatility into vision. That's right, how independent advisors help lenders lead. I am thrilled and honestly, maybe just a tiny bit intimidated to welcome our guest, John Rothfield of Derivative Logic. John is an economist and advisor who has spent his career helping institutions and lenders translate uncertainty into strategy. And we're going to dive into some of that today. From his time at Bank of America and CalPERS to the incredible work he's doing today at Derivative Logic. John, thank you so much for joining us.
Really appreciate it. Love to be on your podcast, Paul.
Yes. So, you know all about the California MBA, and all of our listeners know about the California MBA. And so now it's time to learn a little bit about you in Derivative Logic. So I'm going to jump in with this question, and it does help us gain a little insight into you. John, how did you get into the industry? How did you break into the industry?
Well, I can speak to start with the co-founders, who are Rex Evans and Jim Griffin. And both Rex and Jim had worked in commercial/investment banks doing interest rate and FX advisory. And they had long careers. Rex's career for a long time was with Bank of America, where I also worked for 17 or 18 years. And Jim Griffin worked for a number of US-based financial institutions on the banking side, so doing the structures and execution, etc., for long periods of time and gaining a lot of experience. And so they went out on their own and have been doing this independent hedge advisor work for a few years now. And I think they bring a lot of experience, and they're very good at what I would call know your customer KYC, which we were very good at with Bank of America, which basically is that every client is different, and they have quite a diverse portfolio of clients. Anyway, when I left CalPERS, the state pension fund, where I'd been working on the so-called buy side for a significant period of time, Rex contacted me and said, "How would you like to be a consultant for us?" And that's what I'm doing. So I'm kind of going back to, instead of being on the road so much with Rex, going to all different places in cars and planes and visiting clients, some of this stuff has been online, which is interesting. But we also get out on the road and meet with people. And,
Right.
So that thing of those things about experience, respect for the client, knowledge, education, teaching clients so that they know what their options are, that kind of thing, and again, that KYC. And
Yeah.
I've really enjoyed the time that I've been working so far with Derivative Logic.
Yeah, it's been inspiring. And in doing, I did a little bit of research on you, John, and Derivative. And I found that you've written often about learning from volatility, right? So learn from what's happened in the past, which is really important for us as humans, professionally and personally. And so in reading through some of what I uncovered, what has this cycle taught you personally about resilience and leadership? Because this was a tough cycle. We kept on thinking we're going to come out of it. Oh no, we're going to come out of it. Oh no, we're going to come out of it. And now there's some good hope, because as we learned with KP at PRMG yesterday during our membership forum, it's not just about what the feds do, but data. And so we've got data in our favor. But can you speak to us a little bit about what this cycle has taught you personally about resilience and leadership?
Yeah, I think that's interesting. I would call this year's economy, it's been a very transitional, disruptive economy from a Biden-Harris to a Trump-Vance, whomever economy. I would call P.T. Anderson just brought out a new movie called One Battle After Another. And it's kind of like a one battle after another economy this year. So we've actually had a lot of uncertainty. There's something called the uncertainty index, which scans media. And that index has been, 3 or 4 times its long-term average this year. So uncertainty is kind of there's an element of paralysis with uncertainty. You've got a project that goes beyond any short time frame. The problem is that you can't plan if you don't have a clear guide map to what the economy is going to look like in a particular period of time. So we've had high uncertainty, and yes, I think you're right, is that we may move from this one battle after another economy into an economy that with slightly more clarity going into next year, if only because there are midterms next year, and the administration would like a smooth economy going into the midterms. One interesting thing about volatility is, although we've had a lot of uncertainty, volatility has actually been quite low. If you look at the VIX index of the stock market volatility, or Bank of America's MOVE index of bond market volatility, it's actually been at or below its historical average this year, believe it or not. And right now, it's actually significantly below, because ever since February, the shock when the administration introduced its Liberation Day tariffs, when the market suddenly started to crash and burn, interest rate spreads started to widen. There was initially something called the taco trade. Trump always chickens out on tariffs, so don't worry about it. He doesn't want a recession, otherwise the budget's going to blow out. I would more call it what they call a Trump put. So both the President and the Treasury Secretary, Scott Bessent, and also whomever is going to take over the Fed next February, essentially are doing their best to guarantee more stability in the financial markets. Now, experience over time tells us that despite these efforts, invariably something happens, a policy mistake or
Right.
unintended consequence. So I think that's where we are. But as far as what this has taught us, these periods of volatility have taught us, I came up with 3 or 4 things. One is knowledge.
Okay.
So I found this when I worked at CalPERS. You have a whole bunch of investment banks coming and giving you advice. Sometimes it's conflicting advice. It's good to take ownership and have your own view of something.
Yeah.
And therefore to be able to sort out which piece of advice makes sense. Secondly, have a process. So at CalPERS, for example, when the global financial crisis happened in 08, 09, there was a lot of kind of panic, and I would call it, a little bit of disorganization about what to do. It was a totally new thing, returning back to that kind of situation. We had a different CIO and different circumstances during the COVID shutdown. And the CIO at that time, Ben Meng, instituted a daily process that wasn't really looking at the macro data or anything else like that, but it was basically saying, what are we seeing in the markets that we're involved in? Is there liquidity? Is there this and that? And so we kind of moved to a daily thing. And one important thing I think that Ben also taught me about having a good process is sometimes a good process leads to a bad outcome. Sometimes a bad process leads to a good outcome, almost by mistake. And so there's something called resulting, and resulting says even you trust in your process that over time that process is going to deliver better outcomes, and don't be swayed by the fact that maybe a good process at one time leads to a bad outcome. A third thing I would say about volatility is to respect the different time frames. So PIMCO, the big West Coast pension fund, has a
Yeah.
daily investment committee meeting. but it also has a quarterly cyclical forum, and it has an annual secular forum. Think about the different timeframes involved in the space that you're in. And then, of course, the typical one, which is manage financial risk dynamically, be active, flexible, dynamic, and opportunistic is, I think, a very important one. You know, if you we've had a downdraft in interest rates again recently. If you believe that that's temporary, be optimistic about it. And then finally, I think a very important thing is to, and this goes back to knowledge, is all markets are connected. So the interconnectedness of everything. At CalPERS, we spent a lot of time in Japan, not because we had much of Japan in our portfolio, but because Japanese institutions were buying CLOs in the United States. So understand the interconnectedness of market. The interest rate environment that you're facing has very actually little to do with the housing sector. If it did, then interest rates would be lower because of supply and demand. Interest rates are set in the big market, which includes global as well as domestic, and spreads, the spread markets, and then some idiosyncratic factors that have to do with your industry. Everything's interconnected, and one has to have an appreciation for all of the factors that go into pricing the financial asset, the financial products that you are looking at.
Yeah. I want to say two things, John. One, I should have asked everyone to grab a pen and paper. As you were talking, I was taking copious notes because there's so much information jam-packed just in that one response. And two, as we're talking about managing financial risk, I love the concept of the interconnectivity because all things are connected. And then respect to time. As it relates to those functions and many more, obviously, but leading into this next thought that I wanted to get from you, I'd be very interested if you could share a recent example where smart hedging or risk analysis made a measurable difference for a customer or client's outcome.
Okay, well, I'm going to do one from me and one from Rex, our co-founder, Rex Evans, our co-founder. So 6 days after Liberation Day, when the markets were collapsing, the markets were pricing in recession, the investment banks were talking about more than 50% recession risk and even putting it in their best case scenario for this year. And the interest rate markets were pricing for recession. On April the 7th, we did with Marquette Advisors we did a economic outlook in the shadows of that meeting and all the volatility and downdraft in interest rates that caused. And the essence of our recommendation at the time was we didn't think that tariffs, which I think at one stage would average 15%, so it's like a 15% tax. We thought the economy would probably be resilient enough, and then there would be significant changes to that and also adaptability by corporations to think that there wouldn't be a recession. So the downdraft in interest rates that happened at that time, they got very low into the ones for the Fed funds target and stuff like that. The recommendation at that time was to potentially take advantage of that lowering of interest rates that happened at the time. And, so I think some clients took advantage of that in individual transactions. You're not going to get it right every time, but if you go through an economic outlook and say why you think this is the case, and again, people using their own, taking knowledge of their own, ownership of their own knowledge can decide for themselves whether they think that's a valid viewpoint and execute that way. The one that Rex came up was a borrower had to hedge floating rate exposure. There was a mandatory cap on that with a 4.5% strike. And they wanted to do a 3% strike to prepay. What Rex proposed, and there haven't been that many of these done in the firm, was a corridor strategy where you purchase a lower strike cap and simultaneously sell a higher strike cap. And what that did was it maintained the comfort of meaningful protection, but it also reduced a portion of the premium cost. And so the borrower got substantial premium savings while maintaining adequate rate protection. And it's actually appreciated in mark-to-market value, but more important, creative structure, transparent lending, and it made an expensive mandatory hedge into a capital-efficient, risk-balanced hedge.
Oh,
So,
wow.
and again, that is an example of this may be suitable for some clients, and in knowing your customer
Right.
says you look at their appetite for risk, what their knowledge is, what, stress testing, what different interest rates environment would be to them, and the client jumped at the opportunity, and they got put into a good corridor.
Yeah, and it became a win-win out of something that couldn't have been. So that's fascinating. Thank you for sharing that. Now we've talking predominantly about so far in our conversation, and we've talked about hedging, risk analysis, and what your experience has been and what you've learned from volatility, specifically to this cycle. So as we're talking about current events, if you will, or our current time, speaking of that, this certainly has been a year where for businesses and financial market participants, uncertainty and the huge need for flexibility have been higher than normal.
Mm-hmm.
One of our recent challenges, which I'm just really starting to dive into myself, has been the federal government shutdown, which began just a couple of weeks ago. And I think many of our members in our industry are really wondering how long the shutdown will last for and the related challenges to the federal functions and how that might ripple through the financial markets, regulatory bodies, as well as the broader housing finance space. So from your vantage point at Derivative Logic, what are the biggest near-term and midterm risk you see with this shutdown, particularly around rate volatility and potentially the delayed for economic data, right? Clouding the Fed's decisions. Mm-hmm. When we opened up, I spoke about how I just learned from Kevin Peranio at PRMG, it's not just what the Feds do, but the data that comes out. So if you, and unfortunately we don't have too much time left, but I'd love to hear your thoughts on, do you think this is going to be a long shutdown? And what does that do to our marketplace, specifically housing?
Well, the government has these shutdowns that almost no other country has because we have debt ceilings, et cetera. So at one stage there was bipartisan support for actually getting rid of the debt ceiling, but and trying to go budget to budget, having a proper annual budget, but that hasn't happened. So since the mid-90s, we've had three multi-week shutdowns. One was in the mid-90s, one was in 2013, and the latest one in 2018-19 was 35 mm-hmm. days long. That's the longest we've had so far. And we're 16 days into this one. So the important thing to note about the 2018-19 one, which was in the Trump first term, toward the end of around Christmas time into the new year, which is kind of like a little bit of a dead time for financial markets, the Bureau of Labor Statistics was actually open. It had been funded. So they were still able to have the employment report and the consumer price index report, which, as you've mentioned with the Fed's dual mandate, they're the two main reports that the Fed uses to determine whether they want to change interest rates or not, what's happening with inflation, what's happening with the employment market. So it is a big deal. And you have to put this, though, in a longer context, which is since the 60s, there's been almost no growth in federal employment. Despite the fact that the population of the country has risen by 68%, government spending has gone up fivefold or something, government functions. So there's been a lot of technology and a lot of outsourcing. So contractors 2-to-1 relative to actual. So there's only 2.3 million federal workers left outside of the post office system. Well, I say only, that's still a pretty big number. Mm-hmm, the administration, though, however, this year, as well as the shutdown, they want to use the shutdown as an opportunity to get the federal labor force down by another 300,000 this year. So from 2.4 million to 2.1 million. That is a big deal at the moment because the steady state employment growth in the economy is only about 40 or 50,000 right now. The market's only absorbing about 40 or 50,000 people per month. So putting potentially up to 300,000 people on the unemployment has feed through into just about everything. Retail spending, although most retail spending now is happening by the top 20% of earners, not people
Right.
not the unemployed, and also the housing market, right? So
Yeah.
one of the big impacts on the housing market is whether the unemployment rate is changing. And so we're likely to see a tick up in the unemployment rate. With regard to, and also some of the things that are needed in the housing industry, regulation, flood insurance, various other aspects of
Right.
lending suddenly shut down for an unknown period of time. So it's pretty important for a sector that's not really causing this like it did in the '08 recession, but the collateral damage that's being done by things to real
Right.
estate. So it is a big deal. There is plenty of private sector data out there, Indeed, Lightcast. The feds, the 12 regional feds put out their own data surveying companies in their region about employment plans, CapEx plans, what they're seeing on prices. So there's some of that data. They assemble that all into something called the Beige Book.
Hmm.
And the Small Business Association also does its survey. So there's plenty of so-called what they call soft data, Beige Book, NFIB, the Institute of Supply Management, and these private sector firms like Indeed, Challenger, Lightcast, etc. So there is plenty of private sector data, but ultimately, despite problems with the official data, ultimately you need to see what the unemployment rate is,
Yeah.
how fast employment is growing, and what's happening with inflation. So it is a big deal. What I think it will do in the near term is from a risk management perspective, it means the Fed is almost certain to cut rates again on October the 29th,
Okay.
which the market has largely so-called priced in. That additional cut in rates has already been priced in. But I think they're going to do it probably another 25 basis points. And I think another 25 basis points in December, whether or
Okay.
not the shutdown ends by then. So I think that the way the shutdown is going to affect right now, if you're talking about 300,000 less federal workers this year into a market that's not hiring, so both firing and hiring are pretty low, it is a big deal. And from a risk management perspective, the Fed will continue to cut. Now, what I think this means for going into 2026, just very briefly,
Yes.
is that I do think that, where the economy has been in this transition from a Biden-Harris economy to a new kind of economy with plenty of government interference and wanting to affect the price of things, but also where next year there's going to be net tax cuts and various incentives and a lot of promises to build infrastructure in America. And,
Hmm.
and I do think, particularly if there is an effort by next May to install somebody at the Fed who doesn't believe in the 2% inflation target and is basically seen as a henchman or something like that, or henchwoman for the Trump administration, then you're going to have a melt up in interest rates. And right now, the market is saying that by the end of next year, there's going to be 2 and change on interest rates. But I do think that the main risk next year is that we do get a melt up. And so, we were talking about before about corridors and caps. There is also something called a swaption, which is a right to buy a swap, a right but not an obligation to buy a swap. I would be taking advantage of the current low interest rate structure and maybe even the disruption that happens again in the next month or so to kind of
Yeah.
lock in for a competitive medium-term advantage into a structure that protects you against this risk of reflation, a successful transition to a new economy, and that kind of thing into next year.
Yeah, it's a touchy time. Lots of fluctuation going on, and
Yeah.
your insight was, God, your knowledge was so insightful, I should say. John, I learned so much. I have a page full of books, or I'm sorry, a page in my book full of notes. So I want to thank you so much for joining us and sharing your perspective. For our listeners out there wanting to follow your insights, I would ask that you check out your blog, What I Learned This Month, on derivative.com. I was on there for a little bit and I learned quite a bit. I personally think it's one of the cleanest or clearest reads in the market that you'll find. So for everybody listening to our podcast, make sure to go check that out. To access all of our Connect podcast episodes, follow our YouTube channel. We're also available on SoundCloud, Apple Podcast, and Spotify. We'll be back in 2 weeks for another episode of Connect. John, again, thank you for your time, and we'll see all of our listeners next time.
Paul, it's been an absolute pleasure and really enjoyed the tenor of the conversation. It's been great. Thank you very much.
Thank you. We'll see you soon, John.
Yep. See you, Paul.
Bye-bye.